I be keeping all y'all money. I don't be putting them bets in.
I know you don't.
I win. I knew it.
All right. So
See, Chris, that's my dog.
he really shiesty.
I win.
So, so today, I want to talk about trading psychology, uh, and honestly, this is one of the most important aspects to trading that is often overlooked by a lot of traders, and they don't really pay attention to it, and so it puts them in a constant state of emotional distress. You know, they always find themselves up in bad situations because they don't understand the psychology behind trading. So I want to discuss that with you all and kind of help us take the next step up. So um, the four sections that we're gonna talk about is, excuse me, why is this important? So as I mentioned earlier, this is the underlying factor between uh,
Crying.
traders
Stop crying.
and losing traders, and because if if you don't properly assess your emotional state, your mental state, you can get caught into a state of fear, a state of being emotional, and you can kind of put yourself in bad situations instead of keeping an objective perspective on the whole market. For two, we have to understand that uh, the market is a paradox environment. And what I mean by that is the market, in the sense it does what it wants, it moves differently. And so you have to accept and embrace the fact that uh, this is a different environment and you have to adjust and you have to accommodate to the market, not the market accommodating to you. The third aspect of why it's important is it's filled with financial risk. I put that in there because we often have an emotional attachment to our money. And with this emotional attachment to our money, if we don't properly uh, assess how we are in the moment, this financial emotional connection can cause fear. It can cause, um, well, really, it really causes fear and it causes greed because you can either get in the trade, you winning, and you're like, okay, I'm being greedy. I don't want to take what I have, trying to get more. Stock reverses. You looking sad. Or for two, you can have the fear of losing money. So then you getting out of trades too early, costing yourself money, or you holding on trades too long, costing yourself even more money. Or it can cause a fear to where you're even scared to get into the trade, and which can result in you not making any money at all. Um, and the last section is the 20 habits of successful traders, which uh, we'll go over towards the end. Okay. So, understanding trading psychology. Um, you have to understand risk acceptance, risk tolerance, and risk management. If you can understand risk acceptance, risk tolerance, and risk management, this can take you from being amateur trader who basically gambling, losing money all the time, to a good trader who is profiting consistently and, and growing. So risk acceptance, what is that? So risk acceptance is being able to accept the fact that each trade you get into is a risk, which that means it can go north, it can go south. And you have to be able to accept that risk to even get started, get into the trade, and then you have to accept that risk to be able to properly uh, handle yourself while you're in that trade as well. Risk tolerance. So risk tolerance and risk management kind of go hand in hand. And so the risk tolerance is going to be, what can I tolerate? How much risk can I tolerate for myself? And you have to be able to make that decision before you even get into a trade. Because if you don't have that made up, things can turn really south really quickly. And if you don't have your risk tolerance you can lose a lot of money, and you'll often lose a lot of money if you don't have that prior to entering trades. Risk management. So risk management is more of a process than it is psychology, but um, it goes hand in hand with trading psychology because you have to properly utilize psychology to make your risk management effective. Because you can have a risk management plan in place, but if your psychology messed up, you won't abide by that risk management plan. And we'll go over all of these as well. I give y'all some time to take note of those three because those are like a big three when it comes to trading psychology. Okay. So the next bullet is understanding what the psychological gap is when it comes to trading, and it's often referred to as the trading mental block. And the trading mental block, in a sense, it separates the good traders from the bad traders because uh, the good traders are able to properly understand, practice trading psychology, and help themselves take that next step to becoming successful traders, consistent traders. And the four trading fears, we're going to talk about that on the next slide, I believe. It's basically the fears that come with trading, which impacts your trading. Um, and then I want to talk about the impact of psychology in trading and how it makes or breaks traders. So to understand the market, we have to understand the uncertain principle. And the uncertain principle basically uh, explains that it's impossible to be 100% correct on every trade you enter. It's impossible to predict the future with, like it says, absolute accuracy. And so you have to understand that when entering a trade can go either way, regardless of the perfect setup, regardless of how much you believe in that stock, regardless of um, the fundamentals behind that stock. You have to understand that it can go either way and that it's impossible to predict the market with perfect accuracy. So um, with that, um, you have to trade and be in harmony with the market, as it says below, and not trying to impose your will on the market. And when I say impose your will, I mean, for example, um, I love Tesla. I want Tesla to go up every day, and regardless of if Tesla is selling off, trading in a downtrend, I can't force the market to go in uptrend. So you got to be able to understand, okay, the market is in a downtrend. So my perspective should be focusing on downtrend movements, downtrend trading. And so next, we're going to talk about the 5 fundamental truths. So the 5 fundamental truths is 1, anything can happen. And like I said earlier, you got a perfect setup, indicators, price action movements leading towards the, perfect trade, and it can reverse. So anything can happen. 2, you don't need to know what's going to happen next to profit. So that goes back to the uncertain principle. You don't know what's going to happen. You can't predict the future. And so you don't have to have a clear, like you don't have to say, okay, this is going to here, because nobody knows that. So in order to profit, you don't have to know everything. You just have to have your setup, your trading plan, and be confident in that and assess your risk. For 2, there's a random distribution between wins and losses for any given set of variables that define the edge. Basically, what that means is that there's a possibility there's a probability for you to win, there's a probability for you to lose at any given trade that you get into. And so that kind of correlates directly with number one, but I'm just following the 5 fundamental truths. Number 4, an edge. In other words, to clear what an edge is like a trading plan. An edge is like a trading strategy that one uses to enter and exit trades. So an edge is nothing more than an indication of a higher probability. Be clear, higher probability, not certainty. And so that's number 4. Number 5, every moment in the market is unique. Although certain stocks tend to repeat themselves in patterns, they kind of repeat themselves in patterns, but they all are not the same. It's always a difference in each different movement in the market, or if you look at the market as a whole, or you look at the market as an individual company, each moment is different. And so you have to be able to proceed with that. So if you want to screenshot the 5 fundamental truths, here's your opportunity to do so. Okay. So how do we master trading psychology? First and foremost, you have to understand your level of fear. How much fear do I have? And to do so, you can kind of, how I do so is I'd be like, I don't want to lose this amount of money. And that kind of goes with my risk tolerance, risk acceptance, risk management, like I said. So you manage your fear by implementing risk management so that you minimize your potential losses and you maximize your potential profits. So how you manage fear is you develop a plan, and you got to be cognizant of your fear. You can't be arrogant to the fact or prideful that I have fear of losing money. That's normal. It's in all humans. So you have to be humble enough to admit that, okay, I have a fear. You have to be smart enough to implement a plan to manage that fear, minimize it, because fear causes errors. I can't emphasize that enough. Fear causes errors. So,
Gotta be heartless. Cold-hearted trader, man. Cold-hearted traders.
Yeah. So that's why I tell people, like, when people ask me, how much money should I start with when I'm trading? I always tell them, start with however much you're okay with losing. Because if you're okay with losing a certain amount of money, the level of fear will kind of die down a little bit. I mean, it'll still lie there because you still have that emotional attachment, but it won't be as great as you need this money or you're going to be looking for next month's rent. So the four character traits that's vitally important to your success of trading psychology and trading as a whole is you have to be confident, you have to be humble. And when I say humble is when you're on a hot streak, you have to be humble enough to know that I still can lose. You have to be humble enough to say, I'm afraid, I don't know what's going on. You have to be humble enough to where, and you have to be confident enough to where if you're losing, you still have the confidence to get into the fifth trade as your previous 4 losing trade. You have to have that confidence to keep going, have to have that confidence to get into trades, you have to have that confidence to get out of trades. Patience. Patience is tremendously important. And I'm starting to see this more and more as I grow personally as a trader, and is that you have to have the patience to wait for your setup, because as soon as you try to force something, try to force a trade, or like, dang, the market's been open 15 minutes and I haven't made a trade yet. The market's been open 30 minutes, I haven't made a trade yet. So I'm gonna force something. That's when you're gonna lose money, and it's gonna cause that emotional roller coaster, emotional stress, because you're like, dang, why am I always in this position? So patience, but also patience is having the patience to let your winner trades run to their full potential, and not cutting your wins short. And so patience is huge as well. And then the last one is discipline. I think this one is just as equally as important as patience, because you have to have the discipline to follow a trading plan. I mean, because you can have a perfect trading plan set out, but if you don't have the discipline to follow it, if you don't have the discipline to have the patience to wait for your entries, have a discipline to take your profits, extra exits, you're gonna be um, pretty much a losing trader, because you're gonna find yourself in losing positions all the time, although you have this perfect understanding of the market, of indicators, support and resistance, all of this. But if you don't have the discipline, you will be a losing trader. And so a way I like to think about trading and trading psychology is that you have to think like a chess player. So when you playing chess, you're always thinking about how to take the next step ahead, how to anticipate potential movements from my opponent. The probability of, if I move my queen right here, the probability of them countering that with a move that's going to take my queen out, put me in checkmate. You have to think, and you have to have this sense of forward thinking, anticipating, not reacting, anticipating, not reacting. And the next point, you have to execute without hesitation. You see the right setup, you see the signal, you see the right entry point. You have to get in without hesitation, without thinking about it.
No pump faking.
No pump faking. And you have to do the same thing when it comes to taking profit and cutting losses. You see a stock running up, and say your profit target, you hit your profit target, and you say you scaled out of your position, and you let it run a little bit, but then you see that it's indicated on the reversal. You have to get out without hesitating, without thinking, okay, well, maybe it might go back up. Maybe I can make a little bit more money. No, you need to get out immediately, expeditiously. Same with cutting losses. It hits your stop loss, you need to get out without even thinking about it, without even saying, okay, I lost this much. Get out, because your losses will turn to greater losses. And understanding that the market does what it wants, which I've been harping over, because this can save you a lot of frustration. Because if you understand that the market does what it wants, and when you see that the market goes against what you anticipated it to be, you won't become frustrated, because you understand the market does what it wants. Regardless of anything, the market does what it wants. And so you need to understand that. Oh, give anybody time to screenshot that or whatever, and then we can proceed. Okay. So I put 20 habits of successful traders, but it's really not 20. I think it's like 15. I don't know why I put 20. But number one, successful traders are patient with winning trades, and extremely impatient with losing trades. And this is key, because often losing traders they would get into a winning trade and they so quick to take profits. Let me lock in these profits. Let me lock in these profits. And they cut their profit margin so small. But when they in the losing trade, they like, let me hold on to this because I know it may go back up. I don't lose my money till I sell. But
that sounds just like me.
yeah. And so in actuality, you have to do the inverse. You have to be patient with your winning trades, and you have to be extremely impatient with your losing trades. That's a key one to take note on. You have to be patient with winning trades, extremely impatient with losing trades. So this number 2, this is a typo. So right now it says, understands that making money is more important than being right. That's not right. That is right. Making money is more important than being right. So making money doesn't always mean profiting. Making money can be cutting your losses small so that you can get into another trade to profit. So when it says understanding that making money is more important than being right, is that a lot of times when we trade and we have this sense of pride connected to our decisions when it comes to getting into trades. And so if a trade reverses on us, we have this pride of saying, I know I'm right. I know my setup was right. Everything was right. And so we don't want to cut these losses, and it takes us away from making money. So we have to understand that making money is more important than being right. Number 3, successful traders look at charts as a picture of where traders are lining up to buy and sell. When I read this, and when I read this first, is successful traders, they look at the charts for potential entries and exits, potential opportunities. They don't just look at a chart and just say, oh, this is going up. Oh, this is going down. I don't really know what this chart is doing. But what a successful trader does is we look at charts and we say, okay, we see rising volume, we see breaking of these indicators, we see indicators on the RSI, we see supports being broken, high volume. So we're looking at a potential right here. You know what I'm saying? So basically, every time you get into a trade, you're looking for a potential opportunity. You're not just there watching it like it's a movie. Number 4, this ties right into risk management. Before entering a trade, they know where exactly they will exit and enter for a potential gain or loss. Basically, every trade you get into, you have a profit target and you have a stop loss. You already know that. And one area where I would do better is in the trade ideas. When I provide the profit target, I would give a stop loss as well. You know, I typically just been given a profit target, but I'll give a stop loss as well. Number 5, this ties into the character trait of confidence. They approach trade number 5 with the same mindset as they did for the 4 previous losing trades. So you have to have that confidence. Stay true to your plan. Stay true to your research. Stay true to your intuition, and have that same confidence with trade number 5 as you did with the previous 4 losing trades. And that confidence cannot waver, because as soon as that confidence wavers, you'll hesitate and you'll miss big profit opportunities, or you'll be so afraid of losing that you'll cut your profits short, or you'll let your losing trades run too long. So you have to have that confidence no matter what. Number 6, you have to realize that being uncomfortable is okay. So, prime example, today I had my eye on Disney, right? And so I was looking for, so my trading plan is that I like to see clear breaks of indicators, clear breaks of price targets with high volume to validate a movement, right? But Disney did something today that I was not used to. So Disney, what it did was it had a slow, gradual uptrend, and it traded in what we call channels. And so I'll teach on the channels, but channels is it's like a diagonal uh, uptrend, or it could be a diagonal downtrend that the stock just moves right in. And it had a support on the EMA, and it just traded uptrend right up the channel. But it had a decent amount of volume, but the price action, it wasn't clear breaks. It wasn't like just strong green candles, and so I didn't know how to trade that, and so I was uncomfortable, and that's okay. But when you're in situations of being uncomfortable, you have to assess the situation, try to learn from the situation, so that you can grow ultimately. And
I got a question, Diz.
yeah,
So I know exactly what you're talking about. We talked about this a little earlier with the whole Disney thing. So given everything, all the indicators that the chart was showing us for Disney, was that a good trade to get into, given that the volume wasn't that high, and it was moving, but it wasn't moving the way, we normally get into trades. So was that a good trade to get into if we
um,
decided that?
I think it would have been a good trade because the fundamentals supported it. They released the opening of I think it's two parks. Increase of revenue. Earnings is on Thursday, and so
Mm-hmm.
it's a lot of potential because it's a lot of eyes and a lot of momentum in that. But um, my whole thing with trading is to minimize the amount of risk, right? And so I wasn't, since I've never really traded anything like that before. Um, I was hesitant, and I didn't want to trade it or give a signal that I wasn't fully comfortable on. But so like,
Yeah, that makes sense.
yeah, so it's like I think the entry point I was looking at, I believe it was $184.50 or $85.50 or something like that. And I was watching the level, and it broke, but it broke with low volume. So y'all know if it breaks with low volume, I don't really respect it. But then it kept pushing, but the volume was very moderate. And so I was like, I don't know if I want to take that risk. But if one traded it, I think it would have been a good trade because fundamentals supported it, but I just wasn't comfortable. And so,
I got it. Yeah, you answered my question. So
yeah. And so, number 7, the markets. Successful traders view the markets as their workplace, where they are participants, not spectators. So, often for um, beginner traders or intermediate traders, um, when you see all of this price action movement, and you read about these top traders profiting, you can kind of feel like I don't belong. I don't know what I'm doing. Um, this may be too much for me. But in order to be a successful trader, you have to view the market as I belong here too. This is where I make money too, you know. And I'm not just here just watching everybody else make money and enjoying the ride. Like I belong here too. And so I think this is more of a uh, mentality aspect to it. You have to have that mentality of I'm a winner, I belong. Um, yeah. Number 8, they stop thinking about the market as being cheap or expensive. This is huge. This is huge because um, when we looking at contracts, it's a difference from viewing the market as cheap or expensive. and affordable or not affordable. You know, if you don't have the buying power, then of course you can't do nothing about it. But when one has, we talking about this bullet in respects to one having the buying power. So you have to stop making assumptions as to, oh, this contract is too expensive. I don't like how expensive this is, or this contract is cheap, so I'm gonna get into this just because it's cheap. But instead, what you should look for is the value. You should look for the value of the trade, of the stock. If you just buying shares, you got to look at the value. Don't necessarily look at the price. I know it's kind of conflicting to a lot of people, but successful trade look at value versus cheap and expensive.
So, question.
Yes.
So value as in, so what are we looking for as in value wise?
So, so with options, when it comes to options, right, we're looking at, well, typically the trading that we're doing is a day trading, right? We want to get in and out. And so with that, we want a contract with a lot of intrinsic value to maximize these profits as fast as we can, right? But
Okay.
if and so like with these extrinsic values, often they're a little more expensive. You get what I'm saying?
Yeah.
But depending on the type of trading, like if we trying to get in, you know, for a quick 10, 15 minute scalp or, you know, nice day trade, we want as much extrinsic value as we can get. But if we going for a swing, you know, you can kind of get value for going out of the money as well, because you get the extrinsic value on your contracts. And
Okay.
so, when assessing, we have to use the value versus cheap or expensive.
Okay.
You get what I'm saying?
Yeah.
Because we can get into a scout and, like, say for example, we got a signal and the contract $500, right? Say you got $1,200 and you like, I don't want to spend $500 on that. Let me go get the one out the money, you know, for 150, and then instead of your profits being such and such, now you got a much smaller, you know, or you know, and so we gotta look at value versus cheap or expensive.
Okay. That makes sense.
Number 9, they are willing to change sides if the market tells them to do so. So, for example, you could be looking at Apple, and Apple is trading up in pre-market, and so you like, Apple gonna, you know, it's gonna be a nice green day, nice uptrend day. But as soon as the market opens, it's selling off the whole day. You can't still be trying to force the market to go up when it's clearly in the downtrend. So when the market reverses, you have to reverse as well. Pretty simple as that. Number 10, every trader has an edge, quote unquote, or trading plan that they can explain to anyone. You know, somebody come up to me, hey, what gives you an edge? What you know, gives you that step up in the trading plan? I use the VWAP, I use the EMA, I use the RSI, volume, breaking of key price targets, key resistance, key support. You know, simple as that. But you gotta understand that to where you can give it to anybody if they ask. Number 11, they realize that the market will be open again tomorrow. This is huge, and this is one thing I had to realize today. So to give some situational awareness, on my Sundays, watch this that I created for the week, I had Square on there and I had NVIDIA, but I had them on a separate page than I did my other ones, and completely missed them. Not due to work era or work complicated, simply just me missing them. and I believe Nvidia went up $33 today, closing $30, and Square was up, I believe, like $21, $22, something like that. And as much as you see those missed opportunities and you're like, dang, I want to get into this trade, I want to get into that trade, which that's dangerous because it's called revenge trading. You have to realize the market's going to be open again tomorrow. It's going to be other opportunities for me to capitalize on. And so, if you miss opportunities, you realize it's open tomorrow. If you have a bad day, realize the market's open again tomorrow. Another day, another opportunity.
Yeah, it ain't the first stop to go up $30 in a day, and it won't be the last one.
Exactly. Number 12, never, ever, 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 ever add to a losing position. So, if, say for example, we in the trade, and you say you're down $50, don't ever go buy another contract. Don't ever do that. Never do that, because you can dig yourself a bigger hole for no reason. Simple as that. 13. Cash is the goal. Cash, or other words, profit is the goal, but it's never the true measure of success, right? And when I say that, for example, we come in with a great trading plan, and say we got 2 or 3 trades that we in, and all of them reverse. If we cut losses small on all 3 of them and minimize our loss, that's a successful day. And that's hard for a lot of people to understand, because all people see is, oh, I want profit, I want profit, I want profit. Which that is the goal, to have a green day every day and be consistently green. But that goes back to understanding that the market does what it wants. So if you have 3, 4 setups and all of them reverse, well, I mean, what can you do about it? But if you cut all your losses small that day, you had a successful day. Although it'd be a red day, it's a successful day because you minimize your loss.
I want everybody to check into reality too. We all want green days every day, but you can't find a trader out there who hasn't lost the trade. You get what I'm saying? Who's just 100% correct all the time. You're going to lose. It comes with it, wins and losses. But like he said, I didn't even think about it like that. When you're having a bad day, if I have 4, bad trades or losing trades, and I minimize my losses, that's a good day, because I could be in a bit much deeper hole than I was.
Exactly. And so number 14, successful traders have a way to gauge fear, greed, and speed of the market. So fear and greed are huge, right? And we've already kind of talked on the fear and greed aspect of it, but fear, can make you to cut your profits small, force you to hold losing trades longer, can force you to not even get into a trade because you're so afraid of losing, and which can take money out of your pocket as well. Greed, I'll say I've been a victim of this, and I've been a victim of fear as well. Greed you can be into a winning trade. You have clear indicators of a reversal, or just simply being greedy, trying to get more than what your profit target already is, and you end up losing it just for being greedy. And then speed of the market, and speed of the market is so key, and it kind of goes into like the risk management aspect of it, is because if you can gauge the speed of the market, you can gauge how fast this stock is going to push up, or how fast is this stock going to come down if it reverses. And so they can kind of help you get in and out, assess your risk. But speed of the market is key. And in speed of the market, so the speed of the market isn't a market whole thing. So the speed of the market, in my opinion, is different with each stock. You know, if you look at, say, Apple and Tesla, right? If Tesla goes up 9% a day, Tesla's going to shoot up really fast in the first couple minutes of trading. Apple goes up $9 over a day. It's going to gradually, about a medium speed, get to $9. And so you have to kind of understand how each stock moves to know like the timing of your exit points and your entries. Number 15, successful traders practice reading the right side of the chart. You know, so we get our trade ideas, our entries, our exits, planning from the left side of the chart. But and that's before like the market opens or whatever. But we got to learn how to read the right side of the chart. And by reading the right side of the chart is anticipating potential future price action movements, candlestick patterns. And that's what we mean by right side of the chart, is being able to anticipate what's going to happen next and being able to kind of see what's forming before your eyes, in which a lot of times you don't really have to see that if you already have a plan coming in, but it's always good to be able to read the right side of the chart as well. And so I know majority of people don't have a trading plan, and so I wanted to share my trading plan personally and make it our trading plan if you're willing to accept it as well. And so, as you see, I have in bold, the ultimate goal of this trading plan is to minimize risk and profit consistently. That is the ultimate goal, is to minimize risk. I recommend a screenshot of this, a picture of this, or you take note of it. But ultimate goal, minimize risk and profit consistently. So if anything contradicts these in a sense, what we call them core values, you need to go against them. So the first rule is, prior to entering any trade, have a planned entry and exit price. And when you come in with this plan, you want to have at least a 2-to-1 risk to reward ratio, basically meaning that you're willing to risk a 1% movement in the opposite direction, downward direction for calls, or upward direction puts, to a 2-point movement into the direction that you're betting on. That's at minimum. You know, I typically like to find trades for like at least a 3 to 4, but at least 2-to-1 risk to reward ratio. Because if you go into every trade with at least a 2-to-1 risk to reward ratio, you only got to win 33% of your trades to be profitable. Ain't that crazy? You only got to win 33% of your trades to be profitable with a 2-to-1 risk to reward ratio.
Can you give me like a live example of a 2-to-1 risk reward ratio?
Yeah. So I give you a live example. And this is kind of gonna have to be a visual because I don't have one.
Yeah, you good. Go ahead. Just say.
So say for example, we trade in Apple, right? And say Apple, the support and resistance where we're looking at. So the support, it says at 130, and the resistance is at 135, right? Say if the current price of Apple is at 131, and I'm willing to play, we playing Apple to the resistance of 135. So that would be a 4-to-1 risk reward ratio, because my stop loss would be at the support at 130. So if it goes from 131 to 130, we out. But my profit target is at the resistance of 135. So that's a 4-point upward movement. So that would be a 4-to-1 risk reward ratio.
Got it. That made perfect sense.
Yeah. So that's number one. Number two, trust and follow your intuition when decision making. So it could be a trade that you're looking at your own, or it could be a signal. If your gut is telling you this is a good trade, you should get into this, follow it. If your gut is telling you, I don't know, follow it. It's something about your intuition that guides you in the right direction. It's not, I'm not saying that is a 100% guarantee that you're going to be profitable in that trade or but more than not, at least with myself, follow your intuition. It's always it's more than likely going to be a good thing. But when you follow your intuition, you still need to have planned entries and exits planned out before you enter. And this is the third one. This is something that I came into this year with, but I kind of deviated from it. But I learned how valuable it is. Buy the hype, buy the rumor, and sell the news. So what that means is, say for example, with Apple, right? Reports, they're going to report $100 billion in revenue, never been done before, right? So what you want to do is you want to buy the hype of that reporting coming out, and then right before they actually release the news, you sell. Because oftentimes big news like this is released after hours or pre-market, to where you have no ability to cut your losses at all. And so if our ultimate goal is to minimize risk, we're gonna eliminate that because we can. So we're gonna buy the hype right before and ride that momentum, and right before news comes out, we're gonna sell, take our profits. You may lose out on some big after hours and pre-market movements, but then again, just as easily as you can lose out on big profits, you can incur some big losses as well. Number 4, cut losses and take profits at projected targets every time without hesitation. And I can't emphasize this enough as well, because we can go into a trade and we have these, but we don't have the discipline to say, I'm out, right? And once we get to a point to where we buying multiple on multiple contracts, like say for example, we get into a trade and you buy 4 contracts, we can start implementing like a trading process is called scaling in and scaling out. So say for example, we got 4 contracts, we hit our profit target, and we can say, okay, we're gonna take our profit for 2 of the contracts, and we're gonna be patient. We're gonna be patient with our winning trades, like I mentioned earlier, and we're gonna let these other 2 runs. We're gonna readjust our stop losses, and then when they start indicating signs of reversal or any signs of exit, we're gonna get out. But with losses, when we cut losses, it ain't no such thing as being patient. We hit our stop loss regardless of how many contracts we have. We closing our whole position, and we moving on to the next one. And we have to do that without hesitation, without any emotional distress, or nothing. We have to get out without hesitation. Number 5, I will enter the proper trades without hesitation. So that goes is to say, if I have set up that aligns with my trading plan, I'm gonna get into it without hesitation. I'm not second guessing myself, because second guessing myself either leads to get into a trade at the wrong price, or down yourself if you don't even get in at all, and potentially lose money out of your pockets. Number 6, whenever I'm emotionally, mentally distraught, all caps, I will not trade. And after going through this whole PowerPoint, I think you understand why. Because if emotionally I'm not there, if mentally I'm not there, what makes you think I'm going to stay disciplined, confident, humble? Uh, what makes you think I'm going to obtain these character traits that make me abide by my trading plans? So whenever you're mentally or emotionally distraught, do not trade. And like, don't feel like you're missing out on nothing because, like I mentioned earlier, the market will be open tomorrow again.
Yeah, you will have bad days. I had to use number 6 today after that week Super Bowl. I I couldn't even, I told Dan, bro, I can't even focus, bro. I was sitting there looking at charts and I was just so mad, bro. I just put my phone down, bro. I ain't even care no more at that point. So, but I feel good that I did trade. You know what I'm saying? I don't feel like I missed out on nothing. I feel like I made the right decision.
Yeah. And number 7, after a series of winning or losing trades, I will walk away. All caps. So say, for example, and when I say series, I mean like within like intraday, in a day, right? Say, for example, we get into trade, we got 4, 3, 4, 5 consistent green trades. We after we take our profits, we're gonna walk away, close the laptops, close our apps, whatever, and we will not trade again. Because what tends to happen is when you have this super hot streak, especially intraday, you start to get overly confident, and you start to kind of get away from your trading plan. You get into a trade, you lose. Oh, I've been hot all day. This is gonna reverse. I'm hot all day, and you could potentially lose all the money that you just made that in that day. Same for losing trades. If you have a series of losing trades, just walk away, because you're not gonna do nothing but keep trying to force trades and losing more money, because mentally you're not there. Because you then fall to number 6, you'll be mentally and emotionally distraught. So after a series of winning or losing trades, we'll walk away. Number 8, all trades will be based on fundamental and or technical analysis. So when I first started trading, I was telling Chris this story. When I first started trading, I used to base my trades on, I think this is gonna go up. Apple don't never fail me. Tesla don't never fail me. And until I lost 6K in a trade, just off speculative trading with no research or nothing behind it.
Damn.
Yeah, I lost 6 trade. I mean, that's 6 trades, 6K in the trade, and it was because I lost 6K in the trade because I had a series of winning trades. I think I won. I think I made like five or 6,000 in a couple days, and I got overly confident. Got into a trade without using fundamental technical analysis. I got into a trade without having to plan entry or exit price, and I didn't cut losses. I had, like I was telling Chris, I had ample opportunities. I think the first day I had only lost like $100 in that trade. I could easily say, okay, the trade obviously not working for me. Nah, I'm dead. I made 6K this week. It's gonna go up this and third. Next day, I'm thinking I'm down 300-400. Oh, it's gonna go up. Next day, just being stupid. And so that's why I emphasize series of winning and losing trades in a day. Walk away, come back, reset tomorrow. And always fundamental technical analysis. Number 9, all caps, minimize risk. Cut losses small. And number 10, maximize your profits. Let your winning trades run. And this is really applicable to when you have multiple contracts, right? Or for example, if you trade one contract and you hit your profit target, and you can let it run past the profit target, but as soon as any, like me, if I trade one contract and it goes past my profit target, as soon as I see the slightest bit of red candle, I'm out. If I'm trading one contract and I'm letting it run past the profit target. But if you got multiple contracts, we're going to utilize this plan called scaling out. You sell a part of your contracts and you let the remainder run, and then you get out that way. So I definitely recommend screenshotting or taking note of this trading plan, so that even if I send a trade signal and you say you're in the trade signal and you like, okay, it hit my profit target. Do I still wait for this to send a sold confirmation? Or, if it hits your profit target, I'm out, or if it hits stop loss, I'm out. You don't even have to wait, because, often it'll be a delay communicating that, and, but, or even if you make a trade on your own and you trying to grow on your own, which I encourage all of you to try to grow and profit as well. And so that's all that I have for today, pending any questions.
I'm sure.
Well, all right then. We'll be back again next Monday with another lesson, and we're gonna go from there. Hope we're gonna make this week a good week.
Hey, I'm trying to do some lessons too.
You trying to do some lessons, Victor?
I'm trying to teach y'all a couple things, man.
Go ahead, then, Vic. Let me see something. Learn something. Let's see. You see that little